So let's start off by talking about the revenues and the income statement and how to project your revenues in the income statement. I have here as an example the income statement for PSE&G. And the really key thing is to understand what's driving the difference in revenue. Let's go forward for a second and see some of the things that they're doing as we go back to this. And this is the example from the book. I'm sorry that this is not a creative example. I'm doing my own. But I think the one in the book is pretty helpful. So what we're going to do is, once we determine what the increase in sales is going to be, in this case, we're projecting that it's going to be 1%. Then we project other items on the income statement, oftentimes as a percentage of sales. Now, tax is going to be different. It'll be a percentage of pre-tax profit. And again, what we're going to do for 2018 is it's going to be 21%. There may be transitory items, i.e. items that are going to happen one time, or they could fluctuate in all different areas, and we just kind of have to try something there. It could be this year's percentage of sales or something like that. But oftentimes with transitory items, you might just make them zero. If you had a gain on sale of equipment last year, the chances are you're not going to have that again. The company doesn't sell a certain amount of equipment every year. So cost of goods sold will be quite similar. Let's get to, for now, take a look here. Net sales is increasing by 0.1%. So we take 65,299 and multiply it by 1%. And in fact, notice that P&G is telling you this. If you look in the notes, oftentimes, if you look at management's discussion and analysis, they will tell you what they think future sales will be. So cost of goods sold, you may need to do a more detailed analysis. And in this case, what we did was we looked closely at the MD&A. And historically, cost of goods sold was 50.4% of sales. And they're saying that they think that it's only going to be 48.6% of sales next year. And the reason why, it was 52.4% in 2005 and 50.4% in 2006. So what they're doing is there's a certain target savings that the company has called productivity initiatives, and they're able to reduce cost of goods sold by $1.2 billion every year for the past 5 years. Let's assume that keeps on going. If so, cost of goods sold would only be 32,040 or 48.6% of sales. And notice that sales is going up, so cost of goods sold is going to go down by $1,200, but at the same time it's going to increase in proportion to sales. So that gives us this 48.6% here. And that gives us our estimate of 32,053. And this is in millions, so it's 32,053,000,053. Another thing that we have is we have selling general administrative expenses. And all they're doing is they're assuming that it's going to continue as 29% of sales. So here you can see last year is 29% of sales, and this year it's also 29% of sales. Income tax expense is going to be the effective tax rate times the income before taxes. So you can see that over the past few years, 2014 it was 21.1%, 2015 24.7%, 2016 it was 25%. So let's just assume the tax rate continues at 25%. That would give you income taxes of $35.94. And the rest of these items, again, interest expense continues at 0.9%, interest income 0.3%, other non-operating 0%, net earnings from continuing operations, just the total of everything, and we have earnings attributable as a minor item. So these are the types of items. At the beginning, I told you, you have to kind of not make a big deal out of small items and focus on the really big things. So one thing which you may notice here is that these are very small. 0.9% of sales, 0% of sales, other non-operating, 0.5%. These are the type of things that we don't make a big deal out of, because we could be very precise, but in reality, we have no idea what's going to happen in the future. So we might as well not make ourselves crazy trying to predict things with too much precision.